Debt is often described as a tool, neutral, flexible, available to anyone who qualifies. You're told it can help you build credit, buy a home, start a business, go to school. All true, but incomplete. Debt is not just a personal obligation, it is a financial instrument, and every financial instrument exists inside a structure. When you borrow money, you enter a contract. You receive capital today, you promise repayment tomorrow, with interest. Interest is the key variable. Interest is the price of time. It is the premium paid for accessing capital you do not yet own. From your perspective, debt feels like relief, immediate liquidity, immediate access, immediate progress. From the lender's perspective, debt is a predictable stream of future cash flow. Your monthly payment is their recurring revenue. Your interest payments are their margin. That doesn't make lenders villains. It makes debt directional. Money flows somewhere. It never disappears. When you pay interest, capital moves upward toward the institution that provided the loan. Over time, this becomes significant. A mortgage can double the effective price of a home over decades. Student loans can extend repayment well beyond the period of education. Credit cards can compound aggressively if balances are maintained. Each payment contains two parts: principal, which reduces your obligation; interest, which compensates the lender. Interest is the reward for owning capital. Ownership of capital is power, because capital can be deployed repeatedly. If a bank lends $300,000 for a mortgage, it does not simply lose that money. It creates an asset on its balance sheet, a performing loan, a predictable stream of payments. Those payments are valued, packaged, sometimes resold. Debt becomes an asset for the lender. Your liability is someone else's investment. This is the part rarely discussed clearly. Debt is framed as a personal milestone: buying a house, financing a car, consolidating balances. But structurally, it is a revenue contract. You commit future labor to repay present access. That commitment is powerful because it links your time to someone else's return. Every month, part of your effort transfers upward, not maliciously, mechanically. Multiply that across millions of borrowers: mortgages, auto loans, student loans, credit balances. The result is a massive, predictable stream of interest flowing into financial institutions. This is why debt markets are stable pillars of the financial system. They generate recurring income. They price risk. They distribute capital. Debt is not chaos. It is structured flow. And structured flow benefits the owner of capital first. This does not mean you should never use debt. It means you should understand its direction. When you borrow for consumption, the asset often depreciates. When you borrow for appreciation, the asset may offset the interest cost. That distinction matters. But before even reaching that nuance, you must recognize something foundational. Debt is not neutral. It is a contract where time, risk, and capital are priced. And in that contract, the lender is positioned to receive predictable returns. The borrower receives access. The lender receives compounding. Access feels empowering in the short term. Compounding dominates in the long term. If you only see debt as a personal burden, you miss the larger architecture. Debt is a channel through which money flows upward, steadily. Understanding that is not about resentment, it's about clarity. Because once you see who benefits structurally, you begin to ask a different question. How do you move from being primarily the payer of interest to occasionally being the receiver of it? When you make a debt payment, it feels routine: a transfer, a withdrawal, a monthly obligation cleared. But structurally, that payment is income, not for you, for the institution that owns your loan. Banks do not primarily sell money, they sell access to money. Access today in exchange for interest tomorrow. Interest is not arbitrary. It is priced risk, priced time, priced probability. If a borrower is stable, interest is lower. If risk increases, interest rises. But regardless of rate, interest accumulates. And accumulation across millions of borrowers becomes predictable revenue. Banks operate on scale. One mortgage is modest. 1 million mortgages is a structured cash engine. Each payment flows into the institution's balance sheet. Each performing loan strengthens its asset base. Loans are assets to banks. Your debt appears on their books as value. Your obligation increases their leverage. Banks can also bundle loans. Mortgages become mortgage-backed securities. Debt becomes financial products. Those products are sold to investors. Now the interest flows not just to banks, but to funds, asset managers, and institutional holders. Retirement funds hold debt instruments. Insurance companies hold debt instruments. Investment firms hold debt instruments. The interest you pay can circulate through multiple layers of capital markets. This is why debt markets are foundational. They generate steady yield. Yield is attractive because it is predictable. Equities fluctuate. Commodities move. Debt contracts promise defined payments. Predictability attracts capital. Capital seeks stability. Debt provides it. When you commit to 30 years of mortgage payments, you are creating a 30-year cash flow stream. That stream can be modeled, valued, sold, leveraged. It becomes part of a larger financial machine. This is not secretive, it's structural. Debt markets are transparent pillars of modern finance. Governments issue bonds, corporations issue bonds, individuals take loans. All of it generates interest. Interest is the reward for holding capital instead of spending it. If you have surplus capital, you can earn interest. If you lack capital, you pay it. That asymmetry is quiet but powerful. The lender's money works without labor. The borrower's labor services the money. Time flows differently depending on which side you stand. On the lending side, time increases return. On the borrowing side, time increases cost. This is why financial institutions value duration. Longer loan terms, longer payment schedules, more months of predictable yield. And this is why they compete for deposits. Deposits fund loans. Loans generate interest. Interest generates profit. The cycle sustains itself. Most people only see one side of this equation: their payment, their balance, their interest rate. They do not see the layered beneficiaries: banks, shareholders, bondholders, institutional investors, all participating in the flow. Debt is not just between you and a lender. It is integrated into a capital system. Your monthly payment may be small in isolation, but aggregated across millions, it becomes structural revenue. That revenue funds dividends, executive compensation, investor returns, expansion of lending capacity. The system is not built to collapse under debt. It is built to profit from it. Understanding this is not about anger. It is about orientation. If interest is flowing somewhere, you should know where. When you borrow, you gain access. When institutions lend, they gain yield. Yield compounds. Access expires. And the side that compounds ultimately scales.
Pause for a second.
If you're still listening, it's probably because this didn't feel exaggerated. That's intentional. If this way of thinking matters to you, like the video, subscribe. We'll keep going deeper. Interest compounds. That sentence applies to both sides of debt, but it does not benefit both sides equally. This is where asymmetry begins. When you borrow at 6%, 12%, or 20%, that rate compounds against you. If you carry a balance, interest is calculated on the remaining principal. If the balance persists, the cost grows. Time increases what you owe. Now look at the other side. When capital is invested into performing loans, interest compounds in favor of the holder. Time increases what they earn. Same mechanism, opposite direction. A borrower experiences time as pressure. A lender experiences time as yield. That difference is structural. If you pay off a loan early, you reduce total interest. If you extend the term, you increase it. From your perspective, speed reduces cost. From the lender's perspective, duration increases return. That is asymmetry. It becomes more pronounced with high-interest debt, credit cards at double-digit rates, personal loans at elevated risk premiums, subprime lending at even higher cost. When balances revolve, interest compounds aggressively, and because minimum payments are often structured to prioritize interest first, principal reduction is slow. This keeps the revenue stream intact longer. The structure is designed for sustainability, for the lender, not collapse, not chaos, sustainability. As long as borrowers can continue making payments, the system functions smoothly. And because debt is widespread, the interest collected is distributed across financial markets. Bondholders receive yield. Shareholders receive dividends. Institutions reinvest profits into more lending. Capital feeds itself. Meanwhile, on the borrower side, interest reduces optionality. If a significant portion of income is allocated to servicing debt, less remains for ownership, less remains for investing, less remains for compounding in your favor. This is the deeper asymmetry. You are paying compounding while lacking exposure to receiving it. Two people can work equally hard. One allocates surplus into interest payments. The other allocates surplus into interest-bearing assets. Over time, the divergence is significant because compounding is exponential, and exponential curves widen quietly. Interest is neutral in mathematics. It is not neutral in positioning. The formula does not care who benefits. Position determines direction. If you stand primarily as borrower, time works against you. If you stand primarily as capital holder, time works for you. Most people oscillate between the two. They borrow for consumption, they save minimally, they invest sporadically. But if borrowing dominates investing, the asymmetry tilts. This is why financial institutions prioritize asset ownership. They hold capital. They extend loans. They collect yield. They are positioned on the receiving side of compounding. And borrowers, often without realizing it, are positioned on the paying side. Compounding is powerful, but only if it works in your direction. Understanding interest asymmetry changes how you view debt, not as evil, not as forbidden, but as directional. You begin asking, is this debt creating access to an appreciating asset, or is it committing future labor to a depreciating one? Because if the asset appreciates faster than the interest rate, the asymmetry narrows. If it does not, the asymmetry widens. And over decades, widening gaps define wealth distribution. Interest is not the enemy. Ignorance of direction is. If you understand who benefits from compounding, you begin to question which side you occupy most often. And that question changes how you engage with debt entirely. When you zoom out, debt is not just a personal contract. It is a channel. A channel through which capital flows in a consistent direction, from borrower to capital holder. Individually, the transfer feels small. A few $100s in interest, a monthly payment cleared, a balance slightly reduced. Aggregated across millions, it becomes structural movement. Mortgage payments across a country, auto loan payments across a generation, student loan payments across decades. Those flows don't disappear, they accumulate. Interest paid becomes retained earnings. Retained earnings strengthen balance sheets. Stronger balance sheets increase lending capacity. Increased lending capacity expands the system further. This is how debt scales. It is not chaotic extraction. It is organized transfer. Consider housing. A homebuyer borrows capital to purchase property. Over 30 years, they repay principal plus interest. Principal builds equity for the borrower. Interest builds return for the lender. If the home appreciates significantly, the borrower benefits. If it stagnates, the lender still collects yield. The lender's position is structured to be compensated first. Debt prioritizes the capital provider. Even in default scenarios, assets are repossessed. Collateral exists to protect capital. Risk is priced into the rate. Loss is distributed across portfolios. But the flow direction remains clear. The majority of households allocate a portion of lifetime income to servicing debt. That income originates from labor. It transfers upward into capital markets. Over decades, this reinforces ownership concentration. Those who hold diversified debt instruments receive steady returns. Those who service them reduce surplus. Reduced surplus delays ownership entry. Delayed ownership limits compounding exposure. This is where debt becomes a wealth transfer mechanism, not through conspiracy, through structure. If a significant share of income across society is committed to interest payments, and those payments accumulate within financial institutions, capital pools deepen at the top of the structure. Those pools can then be reinvested into more loans, into equity positions, into appreciating assets. Capital feeds capital. Meanwhile, households servicing debt operate with thinner margin. Thin margin reduces flexibility. Reduced flexibility limits asset acquisition. The cycle sustains itself. Debt is not random. It is directional infrastructure. It channels time-based income into capital-based return. If you remain primarily on the servicing side, your financial life revolves around payments. If you transition occasionally to the holding side, your financial life begins to include receipts. Receipts from bonds, dividends from institutions that lend, yield from capital deployed. The same mechanism that extracts from one side pays the other. This is the asymmetry scaled across society. Understanding it changes how you interpret your monthly payment. It is not just a bill. It is participation in a larger capital transfer system. That does not mean reject debt entirely. It means recognize its structural role. Because once you understand flow, you can start asking a more strategic question. How often are you primarily transferring wealth, and how often are you positioned to receive it? Debt is not inherently destructive. It is directional, and direction determines outcome. There are two broad categories: productive debt, extractive debt. Productive debt acquires an asset that has the potential to appreciate or generate income: a business loan that increases revenue, a property that produces rental cash flow, capital deployed into something that can outpace the interest rate. Extractive debt funds consumption that depreciates: vehicles that lose value, lifestyle expansion, short-term gratification financed long-term. Both require repayment. Only one has the potential to offset its cost. If interest compounds against you, the asset attached to that debt must compound faster, otherwise the asymmetry remains. This is the shift most people never make. They see debt as either normal or dangerous. Rarely do they evaluate it as strategic. The question is not, is debt good or bad? The question is, who benefits from the compounding? If the lender benefits more than you, the debt is extractive. If the asset benefits you more than the lender, the debt becomes leverage. That distinction changes behavior. You become slower to finance consumption, more deliberate about financing acquisition. You stop viewing credit as convenience. You start viewing it as capital with a cost. Every interest rate becomes a hurdle. Can the asset clear it? Can it exceed it? If not, you are committing future labor to someone else's yield. Understanding this does not require resentment. It requires positioning. Financial institutions will continue to lend. Investors will continue to collect yield. Debt markets will continue to function. The structure will not change because you understand it, but your relationship to it will. You can remain primarily a payer of interest or gradually become a receiver of it. Even small shifts matter. Owning dividend-paying assets, holding fixed-income instruments, participating in equity positions. Exposure changes direction. You may still use debt, but you use it intentionally, with clear awareness of asymmetry. Because once you see debt as a wealth transfer channel, you stop walking into it blindly. If this clarified who actually benefits from your debt, subscribe for more breakdowns of how capital really flows. Like this if it changed how you see interest and leverage. This channel isn't here to scare you away from systems. It's here to help you understand them. And once you understand the flow, you can decide which side of it you want to stand on.